Okay. And of course, thank you, Ethan, for the wonderful introduction. I've seen some familiar names from the attendee itself, so thank you for tuning back on such a frequent basis. So I think the purpose of having sort of a monthly kind of a webinar is to really provide some updates to you, and of course share whether some of my views whether there's any change or not. So the previous webinar, for those that attended, I share with you some recession indicators. Even though there have been a lot of talks about soft landing, generally my view is that the upward trend should persist unless we see two conditions. One is when the Fed actually revert to rate hikes. Okay, when they find that they are uncomfortable with any inflation resurgence, they feel like they need to do more. They feel like monetary policies need to get more restrictive. Once they revert to rate hike, that is one of the conditions that I believe, in my view, could actually sort of reverse the broader upward trend. The other conditions I think I shared also is recession. We know that growth is slowing. If you were to look at the economic calendar, we just had the US PMI, data from S&P Global just yesterday. Economic growth is slowing, no doubt about that. We have US manufacturing activities reverting back into contraction. And if you look at services, so services has always been that, very strong areas of the economy ever since, the post-COVID-19. It has been driving a lot of the economic growth. If you were to look at the recent PMI data just out last night, it's really hovering, kind of flirting between expansion and contraction. So when we look at PMI data, the 50 level is that divide. Above 50, we say that, the services sector is expanding, is growing. Below 50, we say that services activities are contracting. So yesterday is hovering slightly above 50, underperformed the consensus. So market consensus was looking for it to come at above 51. Around 50, manufacturing dropped to 49.9, slightly below, but nevertheless still in contraction territory. So that really triggered, it just shows that economic activities are still not very strong, even though I wouldn't say that it's weak enough yet. So last month I shared on some recession indicators, the yield curve inversion, the unemployment, some of the jobs data, especially the continuing jobless claims. So I think those views, I'm still holding it. I'm still keeping a lookout for those indicators to show that, over the next few months, if, it starts to show some signs of a recession, I think that will be the second condition where we could see the upward trend reverse. But as of now, of course, we know the Fed hasn't indicated much of, they are going back to rate hikes, and economic conditions are kind of lukewarm, but still not showing those recessionary conditions. So in a way, you can still say that, everything is still basking in this, they call it Goldilocks situation, where economic conditions are not too hot, not too cold, just nice, where things are still going on fine, at least for now. So I think the broader upward trend should persist, but of course, recently we are seeing somewhat of a retracement in the markets. I believe it is a retracement. It is not really a reversal yet, but I believe generally my view, later I'll share with you. I'm looking at. I think the retracement may have further room to in short, we may not have really seen the lows yet. But of course, this could be a retracement. So any further retracement, what are some of the key levels that I'm looking at for deep buying? Later I will show you. But of course, these are some of my views. If you have any question, do feel free to key in the question chat. I'll be glad to answer them after the webinar. Okay, to start things proper, I think I have to go through this, the usual disclaimer. Just do take note that the content of this presentation is for educational purposes only. It's just purely for information. If you are doing your own trading, please perform your own due diligence. So this webinar is really just me sharing my views. Of course, you can concur with me, or you can have differing views. It's totally fine. Markets always have a different view, but this is just what my views are, which I will really love to share with you. So I think Ethan had given a very wonderful introduction of me. I shouldn't bore you again with all where I come from and all that. But I think he shared two. I think the Telegram handle that is IG Asia. So I know Telegram has been quite popular in Singapore. So if you have a Telegram that you're following for market content, can consider following the IG Asia Telegram group chat. So generally, we will have frequent update of content from analysts across the world. So it's not just Singapore. You can have content from US earnings, UK, Japan, etc., etc. So do give us a follow if you have a Telegram account. Okay, so now let's dive into things proper. So if you just look at US sector performance, okay, so this is the US sector performance over the past 1 week. If you look at the chart on the left, in a way, you can see that markets are turning slightly defensive. Okay, how you see this? The outperformance, the outperforming sectors is in utilities, is in consumer staples, financials. So financials has been one of sort of the laggard sectors. We know that growth has been pulling ahead. When we talk about tech, communication services, consumer discretionary, technology, they have been that key powerhouse that has been driving the major US indices performance since the start of this year. Last week, there is somewhat of a defensive shift. So we see some rotation out of these growth sectors. So you see those growth sectors has been the underperforming one on a 1 week or even on a 1 month basis. On a 1 month basis, if you look at consumer discretionary, technology, it has also been underperforming. And the strength is found in last week is in defensive sectors, the utilities, consumer staples, healthcare, and financials as well. So how I look at this, so generally I believe that there is still some risk-on sentiments in play, because if you were to see a fully risk-off, generally all 11 S&P sectors should be in the red. So we are seeing that sentiments are still kind of risk-on, but are turning a little bit defensive. So they want to buy equities, but they rotated out of growth sectors, but where they put their money, some of them are going into defensive sectors, which still suggests that there's still risk sentiments in play, but they are kind of more defensive now. Potentially because we have a series of big tech earnings up ahead that will definitely play a key role. We just had Netflix. I think the trend is this, if you have your share price that has been kind of powering on since the start of this year, generally markets have high expectations for you. So if you just look at Netflix, to be honest, the earnings beat is quite significant. The numbers are great, but of course, market find fault with Netflix outlook. The revenue outlook, below what our market forecast, and we see its share price kind of being punished quite heavily, at 1.9%, kind of a dip initially. So kind of, that is the trend where, your share price has been powering on, markets generally have higher expectations. But on the other spectrum, when we look at Tesla, so if you were to follow, Tesla just released its results overnight, this morning in fact. So not too stellar, they miss on revenue, they miss on earnings, but then pre-market movement, up around 12%. So why? Because same thing on the opposite end is that, its share price has been beaten down since the start of this year, down more than 30%. It is the worst performing S&P 500 constituent, Tesla. And that's why, when you have your shares beaten down, the reverse is true. Generally, markets are hoping to find some consolation. Then now, they managed to find it from their guidance of, a new vehicle, lower cost to compete in the market. They're pulling forward the timeline. It was initially planned mid-2025. Now they are pulling ahead. So by the end of the year, potentially we could see something being done right there. So markets took comfort in that. So we see its share price kind of rally. But of course, if you were to ask me, I mean, we can have this rally, but whether it will, sustain, I believe, I still have some sort of a reservation. I mean, if you look at its revenue and earnings, obviously things are slowing on the end. I think if you look at the EV sectors, things are very competitive. So we have China, a lot of competitors coming in with new models. They are sort of slashing price, even willing to take a loss in order to grab market share. So when you have this sort of margin within the industry getting sort of compressed, things are kind of tough on the end, and we know that demand hasn't been stellar. If you look at China's economic conditions, hasn't been stellar. So, some demand there has been sort of weak. But nevertheless, this has been the trend, right? So if you have your share price kind of high, so up ahead, we have some of the Magnificent Seven stocks. So tomorrow morning, we have Meta. Same thing, share price high. Generally, market seems to have, expect it to perform on all fronts. So we'll see whether it can really deliver on that end. But this is just a general sentiment of where markets are really turning a little bit more defensive. So even with this bounce, generally I had some, sort of reservation. I'm really not too convinced yet that this is the reversal, just yet. Okay, if we look at the macro front, so everyone has been talking about inflation, it's still an inflation problem, still above the Fed's 2% target. So everyone is questioning, how long it will take to go back to 2%. And how long, because when it's back to 2%, it suggests that the Fed has a greater flexibility in terms of its policy, right? So now it is still above 2%. If you look at some of the key readings, so of course the basic one will be headline, will be core. But if you look at some of the key readings, such as the core aspect minus the shelter cost, you can see that it has actually been sort of increasing as well. So earlier in the year, things are blaming, everyone is blaming on shelter costs, housing, rental. They're saying that housing costs, cause this inflation resurgence. If you remove that, things should be fine. Okay, but now when we look at it, things are probably not that fine. If you look at the core aspect minus shelter, the blue bar, things have actually been picking up. So there has been sort of a stronger pricing pressure coming from other segments. So things are sort of the pricing persistence has been broadening out towards the other segment itself. And if you look at the core, the headline, it has also ticked up as a result. Okay, so inflation is going up, so what does this mean for companies earnings, and what does this mean for markets? My take is that generally US inflation can go up, but what we need to look out for is how the Fed actually react to that. Okay, because if they are still guiding for, the next move will still be a rate cut, they still believe that current policy conditions are still restrictive enough for the current inflation picture, markets will like that. Okay, like I mentioned, if they do things that can really dethrone this upward trend, right? The first one is, of course, if the Fed feels they are uncomfortable, they wanted to, sort of push further into higher rates, then that may actually dethrone the upward trend. So we got to look at the Fed's reaction, because there is a chance that they will try to shrug off a lot of this pricing pressure. We have seen that since the start of this year. So US CPI, January, February, March came in above expectations. And what the Fed members say, they argue that, it's just a bumpy path. In their words, they say that it's a bumpy path towards the 2% target. Things will be rocky, but they eventually see it easing towards target. So they feel like, not too much of a problem. I can just hold rates at this level and see how things play out. There isn't a need to go further into restrictive territory. So that is their stance. And if you were to monitor the rate expectation, generally markets are looking for 6 rate cuts. Okay, thereafter, last month markets are looking for 3. So they revise it down with all these higher than expected inflation numbers. Now, within a span of 1 month, markets are looking for 2 rate cuts. Okay, but how does the market react when the rate cuts was revised from 6 to 3? there was somewhat of a weakness, but it continued to rally. Okay, from 3 to 2, that is where, somewhat of a retracement, but I wouldn't attribute it to, sort of the inflation rate. I believe it could just be a catalyst for profit taking. Why? Because, inflation can go up, but if the Fed continue to be tolerant about it, things will still look good for the markets. Because inflation means, your prices of goods and services. When there's inflation, it means firms can raise their price. That means higher revenue. Okay, and higher revenue just means higher profit, and higher profit just translate to upward pressure for share price. Okay, but of course the catch is if the Fed switch their stance 360-degree and they feel like, we got to hike rates again, that is a different story. Because if they hike rates, things get more restrictive, the economic conditions may moderate down, and that's what markets will be pricing for, a weaker economic backdrop, potentially more recessionary risk. So that's a different story altogether. But at least for now, yes, inflation is going up, but what we are really looking out for is the Fed response to it. Okay, so this is the overall inflation rate. We are seeing some slight broadening out towards other segments. So we got to see whether, this trend continues, or whether, it will just validate the Fed stance of being a rocky, bumpier path. Okay, so this is what the markets are pricing for in terms of market rate expectations. Currently, we are in the 5.25 to 5.5% range. So what markets are pricing is that, the Feds will not hike rates further. They will just keep it here for longer, potentially over the next 3 meetings until maybe September. Then they will consider the first 25 basis point rate cut, and by December we may or may not see the second one. So I think based on these rate expectations, this is one of the factor which I believe that the broader upward trend may continue, largely because the Fed's next move is still a rate cut. So Fed can keep things here for longer, fine, but generally when Fed keep rates on hold, markets continue to rally. It's only when the Feds, start to hike rates, that's where market starts to worry. Okay, because higher rates means more restrictive conditions, and of course higher rates means that they're uncomfortable. They can hike once, but once they hike, there could be a second, there could be a third. So that's where market starts to get worried. But at least for now, the next move is still a rate cut. So that is generally supportive. Okay, supportive of a risk sentiment over the broader term. Okay, these are some of the key areas to watch at least over the coming months until the next webinar in May. Some key areas, like I mentioned, reacceleration of inflation. It may cause a high for longer rate outlook, but as long as things doesn't get more restrictive, markets may generally overcome that. And when we see a reacceleration of inflation, it means two things. One, it means consumer demand is strong. That is a good thing, right? Second, it means that firms have that pricing power to raise prices. That is also a good thing in terms of corporate profits. Okay, so generally, if we see inflation around this, 2 to 3%, if it continues to hover around this range, generally that bodes well for their profits, and we should see the rally continue further. Of course, hopefully we see the Fed just stay true to their stance that, they'll just keep rates at this level. Okay, next up, some of the key areas, economic conditions. If you want to know some of the recession indicators that I'm watching, you can look for the previous webinar. So I think those indicators still holds. Third, geopolitical risks. So recently there has been a lot of I would say tensions revolving around Middle East. I think we still have the Israel-Hamas war ongoing. Recently we have Israel-Iran. Things are sort of settling down on that end. So that's fine. At least we are seeing some of the geopolitical risks kind of abating. So when we look at geopolitical risks, what are we looking for? Generally, is there any disruption on supply chain? And is there any disruption on key input materials such as crude oil supplies? So we know that when countries, they have this agreement with each other, they will try to, show what they are capable of, be it in terms of geographical location, like in the case of, for example, in the case of Israel and Iran, right? Israel capabilities is, of course, its military strength, its technology, its military technology. And for Iran's case, I would, obviously, in a way, they are inferior to Israel in terms of the military side of things. But what they can do is they can make use of their, resources, which is crude oil. They can also make use of their geographical location, which is some of the trade routes across Middle East. So these are some of the things that they can try to leverage on to try to improve their position in any tension. But at least for now, I think nobody really talk about it anymore. Things are dying down. They do not want to escalate it further. So we see, yes, okay, at least the geopolitical risks are abating. Okay, but just a general information, if you look at geopolitical tension, historically, when there's a conflict, there may be near-term uncertainty, market doesn't like that, but across the medium term, when we talk about, 3 months, 4 months later, generally, we don't see it playing out as huge an impact on equity markets. So you can think of it as its impact may be generally short-lived, okay, in terms of geopolitical tension. Okay, last but not least, of course, the usual, what I'm looking out for, investor sentiment, some of the market breadth that I'll share with you. Generally, this level, some of the levels will tell you, where markets may have a higher odds of a near-term rebound. Okay, just want to bring your attention to some of the, if you were to follow this CFTC futures positioning, this is the latest read. If you look at the non-commercial positioning. So non-commercial just means, those large speculators and hedge fund. Okay, their positioning in the S&P 500 kind of hit, hit above positive territory. So what this means is that they actually turn net buy. I mean, their position turns, sort of a net long positioning overall for the first time since 2021. So if you look from 2021 all the way to 2023, they have been net short in the S&P 500. So in a way, we know that the S&P 500 has rallied during this period. So probably we can be right to say that some of these hedge funds may have missed out on the rally. So in a way, now they are trying to catch up. So with their retracement, with the recent market retracement, they are trying to pare down on their net short, turning net long as a result. So how I view this generally, yes, they are turning net long, but from my point of view, I had some reservations. I think this isn't a very clear signal for a to jump in sort of yet. Yeah, so this is just my stance, but just to show you that they are really trying to catch up on this rally. But I wouldn't really take it as a as a signal to jump in just yet. Okay, so now this whole presentation is on earnings season. I want to talk a little bit more about earnings season because this is what everyone has their attention on. Of course, this week is a very busy week. Tesla just out, kind of in a way, a positive, kind of a good reaction in share price. But of course, whether it can hold, I will still be monitoring. We have Meta this week. We also have Microsoft, if I'm not wrong, Microsoft, Alphabet as well. So later I'll just go through, what markets really expecting for many of these big tech. And the general stance is that even though things are still rosy for the current reporting quarter, subsequent quarter, especially into the second half of the year-on-year growth may start to slow. So how markets react to that, that could be one catalyst, because if we were to see growth really slowing towards the second half of this year, generally, markets may not like that. Okay, and yeah, that's why we got to see, how things turn out. That's why markets have some focus on the outlook also. Okay, so what's with the earnings season? So my stance is that market performance generally track corporate earnings, generally track economic conditions. Not so much of, I would say, not so much of whether, when will the Fed cut rate. Is it in June? Is it in July? Is it in September? Eventually, those, how it determines is whether how the Fed reacts to that. So generally, we can have a later rate cut. We can see rate cut being pushed to 2025. But as long as corporate earnings continue to hold up, economic conditions continue to hold up, the Fed continues to say like, we are comfortable with the current monetary policies. We do not see any further changes. That should see the S&P 500 continue further. And so I generally believe that, that debate on, should we cut rate in June, July? I know that has been the headline going around in a news article and all that, but my stance is that market performance should still track corporate earnings, should still track economic conditions. So this is the chart of, the S&P 500 earnings per share versus the performance. You can see there's generally this very in-line relationship. So of course, when you have companies earning more money, that translates well to share price. That should translate to an in tandem rise in the broader index as well. Okay. Okay, so when we talk about, because I was just looking at the growth expectations for many of these big tech companies. So we know that over the past few quarters, be it the AI hype and all that, a lot of tech companies have shown very robust growth. And when I mean robust, it's very strong double-digit growth. That is very, very good for the equity markets. But my thought is that, as we head further, there must be a turning point. Okay, so when we have that, very robust year-on-year growth, there should be a turning point where, things should start to maybe slow on a year-on-year basis. So how should we actually sort of position for that? So that's the question I have. So, I managed to look around and I found this, chart that says that generally when corporate earnings sort of reach a turning point in the profit cycle, generally the growth may starts to sort of underperform and the value sectors may starts to outperform. Okay, and when I say growth slow, it doesn't mean that, earnings decline and all that. It just means that the earnings growth, earnings are still growing, but of course at a slower rate. Okay, because there must be a point where, things are, starts to slow down a little bit. You cannot grow you cannot grow like, at this double-digit momentum for so many quarters, right? So there must be a point where things start to slow. So that is what I'm looking at. So when earnings growth starts to slow, generally what these findings show is that value may tends to outperform growth. Okay, meaning we may see a rotation from some of these tech sectors. Once their year-on-year growth starts to slow a little bit, we could see some rotation of capital away from these growth sectors, especially when their valuation are so high, and they have been enjoying this strong rally. So there could be, some profit taking, rotation of capital, right? And where does the capital goes to? It may go to some of the laggard, some of the value sectors in that case. So this is basically what the chart show, which I think is kind of very interesting, because when I look at that chart and I backtrack to some of the sort of performance that we are seeing in the market, if you were to realize actually Dow Jones has been sort of coming in quite resilient compared to Nasdaq over the past few days. So I was thinking, whether are we seeing sort of some form of a rotation from growth to value. So at least over the past week, some of the traction has been towards defensive financial sectors picking up. And of course, there is a sell-off in the growth sectors. So sort of a rotation of capital there. And if you look at this value to growth kind of a ratio, generally things are sort of leaning more towards value. at least over the past few days. If you look at this chart, sort of a breakout, you can say. Previously kind of consolidating. Recently there was some traction being shifted to value sectors. So of course the question now is, can it really continue? Of course, what we are seeing here, could be a fake out. But of course, generally this will be what I'm watching for, because as long as we are seeing that, based on the outlook from some of these tech sectors, if they were to guide for, slowing growth moving forward, we could really see this rotation picking up pace. Okay, so this is the chart of financial versus technology. Generally, it has been at its multi-month high as well. So what this means is that financial has been outperforming compared to the technology sector here. Okay, some of the other things, commodities, we are also seeing some form of a pick up on that front. I think last month I shared on the energy sector as well. Energy sector, the crude oil companies, they have continued to enjoy some run up in that case. But for now, it does seem that, things may still be rosy on that end. Okay, so if you plot the commodities ETF versus the S&P 500, what I'm looking out for here, January previously, there was sort of a bullish divergence back in the January to March period. Thereafter, we see commodities starts to outperform. And if you look at the daily RSI, above 50 for the first time since November 2023. So whether there's a switch to commodities play versus equities, potentially yes, and I am still in a way positive on that. Okay, now let's take a look at some of the charts that I have. Of course, you can have your own different charts, but just sharing from my point of view, some technical side of things. Dow Jones, I believe, kind of trading within a rising channel. Previously, there was a breakdown. So when we have a breakdown of the channel, generally the projection is that prices may decline from the breakout point based on the width of the channel. So in a way, we have seen that sort of played out relatively well. So breakdown of the channel, width of the pattern suggests that price may retrace to this 37,700 level. Things actually touched there, and there was a dip below, but deep buyers were quite strong, jumping in to really defend that level. So we are seeing a sort of a bullish hammer candlestick in play. But of course, whether this marks the eventual reversal, in a way, I still had somewhat of a reservation in a way. I think for now, what we are looking out for is that it has broken down below that Ichimoku cloud. So now it is rebounding back. Will it be able to reclaim the cloud back? That is one of the level I'll be watching. So that will be around the I would say the 38,700 to 38,800 level. That is where the upper edge of the cloud stands, along with its 50-day moving average. So I see that as somewhat of a key resistance. So I want to see the index really reclaim above this level. Otherwise, I still had somewhat of a reservation on whether this is really the reversal. Okay, S&P 500 managed to bounce off cloud support quite nicely. But same thing, at this current moment, what I'll be watching out is whether it will actually form a lower high. So we have a series of higher low, connected by that upward trend line that I drew there. And then it actually broke down, sentiments are taking a breather. It retraced towards the cloud support. So when it bounced back up, I'll be looking for any weakness on formation of a lower highs in that case. So same thing, 50-day moving average, that cloud resistance I'll be watching out for. If you look at the daily RSI, that's one of of course, the reason why I still had reservation. So all along it has been an upward trend. So upward trend means, daily RSI above 50 shows the buyers in control. It has been above 50 since November 2023. Thereafter, it hasn't dipped below 50. So in a way that has kept this very strong rally going. even though we have intermittent retracement along the way, the daily RSI didn't break below the 50 level. Okay, if you notice, so that really kept the risk sentiments going, but it actually broke below that level, back in April. Okay, roughly mid-April, you can see that I've circled it there. It actually broke below the 50, tried to move back, tried to defend that level, failed to do so, which means that sellers are really starting to jump in and take greater control. So now we are deep below that 50 level. So the previous time we seen this dip is when market sort of retraced back in July, August 2023. We had somewhat of a retracement there, where RSI below 50. So now we are seeing it playing out again. So now with that bounce in the S&P 500, what we are seeing is that, yes, the RSI is sort of recovering back, but, it's still below 50. Once it, I want to see how it actually interact with that 50 level. So now it's on the way up. I want to see how it interact, because if we were to see selling pressure coming in, that just means that, that near term sort of, at least that near term downward bias may have further room to go. So this is just my stance. And of course, seasonality, if I were to reinforce it further, generally, average performance for the S&P 500 over the past 20 years, it may, I would say, not a very fantastic month. Okay, around that May, June, you can see that it is a consolidating month. Of course, July, then we will see continue further. This is based on the average performance over the past 20 years. So May, in a way, sort of a more subdued month in that sense. So, I will still sort of keep a lookout, because I know that in a way, seasonality is not fully in my favor yet. Okay, some of the market breadth indicators. Of course, there are a lot of market breadth indicators. Some look at volume. I shouldn't bore you with that, but the easiest one that we can track most easily through TradingView is that, the percentage of stocks above their moving average. So moving average has been a closely watched trend line. The percentage of stocks above that, I look at 50, 100 to 100. So this is the 50 to 100, because, I want to take a sort of a shorter term kind of view. So this is the 50-day moving average and 100-day moving average in terms of the percentage of stocks. So you can draw two borders. Once it reaches around that 92%, things could be overheating a little bit. If it reach deep towards, that 10% range, things could be oversold, and that is where we could have a rebound. Based on current reading, I will say things are sort of at neutral. I wouldn't say that there isn't much of a direction. Things are just moderating from a overbought conditions down to a more neutral kind of a thing. But of course, if you want to argue the case of whether we could see further room for it to touch that, sort of that oversold conditions, that remains a high possibility, right? That still remains, it suggests that there's still room, for market breadth to moderate further. Now, if you look at the NASDAQ, same thing, somewhat of a breakdown of that trend line, and same thing I'm looking at MACD, RSI, those are the basic technical indicators that we all understand, we all know. Same thing, NASDAQ, RSI below 50, that was a dip for the first time since November as well. MACD, same thing, dip into negative territory for the first time since November 2023, and that is where I have somewhat of a reservation. Generally, same thing. Daily RSI below 50 for the first time in months. So now we are bouncing, but until we really move back above that 50 level convincingly, in a way, that is one portion why I still have my reservation. Market breadth wise, at least the near term one that shows that NASDAQ may have somewhat of a short-term rebound in that sense, and we have a series of big tech earnings coming up, so that may help to support some sentiment. But what happens is, what will happen after that? because if there isn't much of a catalyst, if you talk about, May, all of these results may be an opportunity for markets to de-risk further. So we can see a surge, but whether this surge can continue, can have further follow through, or markets actually take any surge to sort of pare down their position. I think things are kind of uncertain right now, and I think there is a possibility that, any rally may see some form of de-risking into next month. Okay, so that is generally my point of view. So in a way, earnings, how has it been so far? We are on our third week, second week, I think, second or third week. Yeah, sorry, I can't remember. But how are things looking out for? If you just look at the breakdown. So for now, this is the S&P 500 constituent. 23% have reported their earnings so far. So maybe 1/5 has reported their earnings. 79% has beat earnings expectation. So if you look at this 79% number, I would say is on par with previous outperformance kind of a figure. So last quarter it was around 77, 78. So now it's like around 79. So things are still, there is still quite a promising bit on the end. But of course, markets are also having their focus on the outlook, because like I mentioned, if things starts to slow a little bit, that is where they may consider kind of shifting their position, especially for some of the big tech companies. So they have been enjoying that, very strong growth over the past few quarters. So the question is whether the growth will start to slow. Okay, because just now I shared, if things starts to slow while economic conditions are still sort of in this lukewarm, healthy state, then they may trigger some form of a rotation. So for now, percentage of companies whose earnings beat forecast, around 79%, are on par, really on par with previous quarter. And if you backtrack to 2013 to 2017, we are above. So in a way, things are still generally healthy so far. Okay, so we have a series of earnings coming up. So with that last 10 minutes that I have, maybe some of you will be interested on, where are markets looking for in terms of the growth picture. And I have my focus on the Magnificent Seven stocks. I believe these are the bellwether stocks. So bellwether stocks just means that, their performance may have a key role on what's happening across the economy. And of course, their heavy weightage in the major US indices should warrant some attention. That is where I focus on those Magnificent Seven stocks. So first up, tomorrow morning, if you're awake at 5 a.m., you will look out for Meta earnings. So first quarter, generally you can see that first quarter should deliver. So we should see growth continue to power on. So past few quarters, 23%. Now we are looking at 26%. So there is a stronger growth right there. Markets may like that. But of course, things will shift towards its outlook. Okay, because for now, markets are expecting that in terms of growth, we may start to slow in second quarter onwards. So of course, Meta will have to sort of, in a way, push back on that. They have to convince markets that no, growth will continue to remain strong, potentially around that 20% range. We won't dip below 20% moving forward. So that could be what markets are having their attention on. So guidance may play a key role, I would say. Apple has really been, while a lot of big tech are enjoying that very strong double-digit growth, Apple is definitely not one of them. That is the reason why it has been that underperforming stocks in the Magnificent Seven. So Apple, Tesla, and there's a reason why. So you can see that the upcoming results, they may show a 5% year-on-year contraction in revenue from a year ago. So that means there is lower demand for its product. And just recently, we have data coming out that China's iPhone demand hasn't been fantastic. So that could create some pressure. So this quarter, some headwinds right there, and whether we can see it recover. even when you recover, current market expectations are that it will just be in that low sort of single digit. So in a way, Apple growth is slowing. So they got to show that they got to show something concrete that they are trying to spur growth, something like what Tesla has done. So revenue earnings for Tesla, significant miss, but they try to convince market that that they are pulling forward with a new vehicle to really try to gain some form of a market share and boost revenue. So I think same thing for Apple. Looking at these forecasts, that seems that they need some catalyst to really convince market that they can continue to grow rather than facing this contraction moving forward. Alphabet wise, I would say things are also quite things are actually quite resilient. We know that this year is a US presidential election. So generally when we have US presidential election, what this means is that there will be a strong boost in terms of political advertising spend. So if you recall back in the previous election, 2020, Donald Trump, Joe Biden that year, that political ad spending reached a all-time high. And this year, the forecast suggests that the spending on political ad is expected to be much more than previous years. So that will definitely benefit a lot of those social ads such as Alphabet and Meta. So these two may stand to benefit this year from the US presidential election. Advertising revenue should hold up around that 10% range. Even moving forward, in a way, Alphabet seems resilient, so things should hover around that 9-10% kind of a range. So I would say growth can be sort of steady. Okay, Microsoft wise, that cloud momentum has really been improving its revenue. So you can see that intelligent cloud segment. So things have been growing, but of course, third quarter, in a way that year-on-year growth may start to slow. Okay, so you can see that column there, third quarter, that revenue may start to slow from previous quarter on a year-on-year basis, and in that cloud segment as well. So how markets may really want to digest that kind of a slowdown, I think that will be something to watch. Okay, because if things starts to slow, then Microsoft share price has been enjoying that stellar run. We could see some sell the news coming in play. Yeah. Amazon, kind of a lukewarm also. So you can see that throughout this whole year, they should grow consistently around 11% year on year. That should be a steady growth, not pulling ahead, but just maintaining its steady state. Nvidia, so of course Nvidia has been that very strong, has been that key darling, right, in terms of the semiconductor space, in terms of the S&P 500 as well. Nvidia wise, you can see this quarter should continue to power on, more than 100% kind of a growth year on year. Second quarter, around 100%, but of course if we edge towards the second half of this year, on a year-on-year basis, that growth should start to come down. So you can see second half of this year should be around 50% growth, 40% growth. So in this way, you can think markets have really two sides to try to balance. Of course, one is that if you talk about a big tech company, 60%, 40% growth, that is still amazing. Okay, that is still amazing. But of course, if you think of the other way, growth, over the past few quarters, we have been hearing that revenue earnings have been, 3 times, 4 times, increasing 3-fold, 4-fold for Nvidia. Now we are just talking about, less than 100% growth, maybe a 60% growth. How does markets react to that? I think both sides, they have some argument on whether, it's time to take some profit. I think that will be something interesting to watch. But at least for this quarter, I think they should still deliver, but their outlook will play a very key role. It will play a very key role because if they were to show some sign of slowing, it just means that demand for this whole AI space, for these chips, has also sort of hit a near-term plateau, and that is where markets may start to sort of pull back. they may start to rotate their capital elsewhere. So this is what I see for NVIDIA. So yeah, with that, it's 8 p.m. Thank you so much for joining for this webinar, and really sorry for the disruption just now. And if you have any questions, I will try to answer them now. Let me just take a look. Okay, how long do you think roughly retracement of this sort of lasts? Generally, there isn't a time period. There isn't a consistent time period where how long retracement will last. But what I personally have is that just based on, if you are familiar with wave theory, I mean, some of you, you may know sort of a wave theory kind of a thing. Generally, a retracement may sort of, we could see a first wave, there may be a rebound, and then we should see a second wave kind of a thing. So now I think we may still be at the first wave. I mean, this is just my view. We can see somewhat of a rebound, but I'll be looking for any sort of formation of a lower high, to continue that retracement further. So there isn't a time frame like retracement will be 1 month, 2 months. Historically doesn't say that, or even the extent of it. There isn't a fixed one. We may hit correction territory. That's 10% from the peak. We may do that. Yeah, but there isn't a fixed time frame. We really got to react to some of the setup that is presented by the markets. Okay, you heard last week there was quite a big institutional interest in buying the dip, particularly the tech stocks. Yeah, probably true. Like I mentioned, many of the some of the hedge funds, large speculative players, they are sort of jumping in, they are turning that long. But of course, they may be right, I may be wrong, but generally I still sort of have my reservation. I still want to see more sort of a more convincing signs on that front. So yeah, I'm still sort of having a little bit of reservation at the moment. Let's see. Another question, views on SG banks for 2024. So I think Singapore banks, if you have it in your investment portfolio, there isn't reasons to liquidate them. They pay very good dividends. Okay, very good dividends, very stable business, and all along their business has been concentrated in Singapore. But if you look across, over the course of past 2 years, they are expanding regionally. So that is where their growth catalyst comes in as well. So they have been trying to acquire other banks in Southeast Asia. So we are seeing, China, Taiwan, and those should sort of complement their growth aspect. So they are growing, but at the same time, they are paying very good dividends. So, SG banks, really from an investment point of view, there isn't much to in a way worry about. Of course, there may be some fluctuation here and there, but eventually I think they are a very good play to have in a portfolio. Let's see. I think that is the question for now.
Okay, thank you so much, Jun Rong, for sharing your insights. So I think we have also another question on the platform side of things. So the question is if the working orders tab can be implemented to instruct to work for pre-market. So for our working orders, unfortunately, you are unable to select whether it's the regular trading hours or the pre or post hours. So as of now, just to answer that, you can't specifically put orders only for pre-market. Okay, if not, then we have come to the end of today's session. I will appreciate if everyone can just take 1 minute of your time to scan this QR code that we have on your screen to share some feedback with us. Let us know what was done well, or what you would like to see to be improved. And of course, maybe what kind of content you would prefer for our upcoming sessions. So we can also try to look for some speakers or professional traders and things like that to share with you their insights. Okay, if not, then we have come to the end of today's session. I want to thank everyone for staying with us throughout. And of course, thank you, Jun Rong, once again for sharing. If not, then I wish you a very good evening for those of you who are here in Singapore. And of course, a good day to the rest of you from the other regions as well. Okay, thank you and good night.